You think you know what builds wealth. But what if I told you that avoiding certain investments matters far more than finding the right ones? In the next few minutes, I'm going to walk you through the 7 wealth destroyers that cost more fortunes than any market crash in history. And if you stay with me until the end, you'll discover exactly why brilliant, hardworking people retire broke while others build generational wealth with the same opportunities. So, before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from. Because what I'm about to share with you could save you from losing decades of accumulated wealth to decisions that seem safe, but are mathematically catastrophic. The truth about what actually destroys wealth. Let me tell you something that took me 7 decades to fully understand. And it's going to challenge everything you think you know about building wealth. See, I spent my entire career studying economics, teaching at the University of Chicago, advising on monetary policy and watching, really watching, how capital flows from one pocket to another. And here's what nobody wants to tell you. The biggest threat to your wealth isn't a market crash. It isn't bad luck. It isn't even a lack of opportunity. The biggest threat to your wealth is doing exactly what society tells you is safe, smart, and responsible. I watched my colleagues, brilliant minds, Nobel Prize winners, people far more intelligent than me in their specific domains, make investment decisions that cost them millions over their lifetimes. Not because they were stupid, not because they didn't have access to information, but because they fell for the same 7 wealth destroyers that have been packaged, marketed, and sold as prudent financial planning for generations. Now, you might be wondering, who am I to make these claims? Let me be direct with you. I spent from the 1940s through the early 2000s watching wealth compound and evaporate. I saw the post-war boom, the stagflation of the 70s, the crash of '87, the tech bubble, the housing crisis that came after I passed. But more importantly, I watched individual investors, doctors making $500,000 a year, lawyers billing $400 an hour, engineers, executives, entrepreneurs, earn more in any single year than most people see in a lifetime, and retire with almost nothing. The difference wasn't intelligence. It was a handful of decisions about where not to put their money. You see, wealth building isn't complicated. The mathematics are actually quite simple. 8 to 10% annual returns, compounded over 30 to 40 years, will make you wealthy regardless of your starting point. $100,000 becomes $800,000. $500,000 becomes $4 million. The formula works. It's been working for over a century. It'll keep working long after we're all gone. But here's the problem nobody talks about. There are 7 categories of investments that will quietly, systematically, mathematically destroy your ability to compound wealth. And the tragedy, the real tragedy that keeps me up at night even now, is that most of these wealth destroyers are recommended by financial advisors, endorsed by your parents, and wrapped in the language of responsibility and safety. Let me ask you something painful. Have you ever wondered why you're working so hard, earning good income, following conventional wisdom, and still feeling like you're not getting ahead? Have you ever looked at your investment statements and thought, I've been contributing for 10 years. Why doesn't this number look bigger? Have you ever felt that gnawing anxiety that maybe, just maybe, you're doing something fundamentally wrong, but you can't quite put your finger on what it is? That feeling you have, that's your intuition telling you something the financial services industry doesn't want you to know. You're not falling behind because you're not smart enough or not working hard enough. You're falling behind because you've been sold products that transfer wealth from you to someone else while pretending to build your financial security. And I'm going to show you exactly how this works, starting with the first wealth destroyer I avoided my entire life. The first one destroyed more wealth among people I knew personally than any market crash. It was something 90% of Americans bought enthusiastically, something financial advisors built entire careers selling, something that carried the word investment right in its name despite being one of the worst investments ever mathematically constructed: whole life insurance. Now, before you tell me I don't understand insurance, let me walk you through exactly what happens when you buy whole life insurance. In 1956, I had colleagues at the University of Chicago who were sold whole life policies. The pitch was seductive. I'll give them that. You need life insurance anyway, they'd say. So why not buy a policy that builds cash value you can borrow against or withdraw in retirement? You're not just buying protection. You're building an asset. Tax-free growth, guaranteed returns, the safety of insurance, combined with the growth of investments. It sounded perfect. It was mathematical poison. Here's what they never explained clearly, and what took me years of analyzing the actual numbers to fully understand. When you buy whole life insurance, roughly 50 to 100% of your first year's premiums go directly to the agent as commission. Not into your cash value, not into your investment account, into their pocket. You pay $5,000, they get $5,000. You get insurance coverage and essentially nothing in your cash value account. Over the next decade, the insurance company slowly, grudgingly begins allocating some of your premiums to this supposed investment account after deducting insurance costs, administrative fees, mortality charges, and profit margins. By year 15 or 20, if you're lucky and haven't surrendered the policy out of frustration, you might have cash value equal to what you paid in. Might. The returns they advertised, 4%, 5%, sometimes higher, weren't returns on your total premiums paid. They were returns on cash value after all those costs were deducted. It's like telling someone their car gets 40 miles per gallon, but only measuring when they're going downhill. I watched a colleague pay $5,000 annually into a whole life policy from age 30 to age 60. 30 years, $150,000 in premiums. His cash value at 60 was $168,000, $18,000 of growth over 30 years. That's a 0.4% annual return. Now let me show you what really happened here, because this is where the mathematics become devastating. If he'd bought $20 per month term insurance for the same death benefit, which would have cost him about $240 annually, and invested the difference, $4,760 annually, into simple index funds, averaging 10%, he would have had $870,000. The difference between $168,000 and $870,000 is $702,000. That's what whole life insurance cost him. Not in fees, in opportunity cost, in wealth he could have built but didn't, because someone convinced him insurance and investment belonged in the same product. They don't. Insurance is for transferring risk. Investment is for building wealth. Combining them is like buying a car that's also a boat. It does both poorly, costs more than buying each separately, and the salesman makes a fortune selling it to you. I never bought permanent life insurance. Not in the 1940s when I was starting my career. Not in the 1960s when I had young children. Not in the 1980s when I had accumulated wealth. I bought cheap term insurance when my children were young and I had obligations. When I had enough wealth that my death wouldn't financially devastate my family, I let it lapse. The money I didn't waste on whole life insurance compounded in stocks and businesses for 50 years. That decision alone probably added 8 figures to my net worth. Not because I was brilliant, because I understood that when someone's compensation depends on you buying something, their advice about whether you should buy it is worthless. The property trap and the precious metal delusion now, the second wealth destroyer I avoided, was something that's going to make a lot of you uncomfortable, because it's so deeply embedded in American culture that questioning it feels almost un-American. I'm talking about investment real estate, not your primary residence. That's a different calculation entirely. I'm talking about rental properties, vacation homes you tell yourself are investments, commercial buildings, the entire religion of property ownership as wealth building. The pitch was even more seductive than life insurance, because it came wrapped in the American dream. Buy property, watch it appreciate, collect rent, build equity, leverage other people's money through mortgages, retire rich. I heard it 10,000 times between 1950 and 2000. I watched hundreds of people follow that path, and with very few exceptions, people who bought large quantities of property in high growth areas and held through multiple market cycles. It destroyed wealth compared to simply owning businesses through stocks. Here's the mathematics nobody mentions when they're selling you real estate, and I want you to really pay attention to this because this is where conventional wisdom completely falls apart. First, transaction costs. When you buy property, you pay closing costs averaging 3 to 5%. When you sell, you pay realtor commissions averaging 6%. Buy a $500,000 property, immediately you're down $15,000 to $30,000 just in transaction cost before you've collected a single dollar of rent or appreciation. Compare that to buying stock in 1975, when I was really active in the markets. 0 transaction costs with the brokerages I used. Second, carrying costs. Property taxes in most states run 1 to 2% of property value annually. Homeowners insurance another 1%. Maintenance averages 1 to 2% annually, and that's if nothing major breaks. You're paying 3 to 5% of property value every year just to own it. A $500,000 property costs you $15,000 to $25,000 annually in taxes, insurance, and maintenance. That's before mortgage interest if you're leveraged. Third, illiquidity. When I wanted to sell a stock position in 1982, I called my broker and had a check in a few days. When you want to sell property, you list it, wait for a buyer, negotiate, go through escrow, and if you're lucky, you have cash in 90 days. If you're unlucky, wrong market timing, economic downturn, you wait years or sell at a loss. Let me tell you about a specific case that illustrates this perfectly. A friend of mine bought 3 rental properties in the early 1990s, paid about $200,000 each, $600,000 total. Spent 20 years managing them, dealing with repairs, evictions, property taxes, insurance claims, finally sold them in the early 2000s for about $350,000 each, roughly $1 million total. Sounds like a win, right? He more than doubled his money over 20 years, except when you factor in all the carrying costs. Property taxes, insurance, maintenance, vacancy periods, property management when he hired help. His actual return was about 4% annually. And that doesn't count the hundreds of hours he spent dealing with tenant issues, repair emergencies, and administrative headaches at 2 in the morning. If he'd taken that same $600,000 and bought an S&P 500 index fund in 1992, he would have had approximately $2.4 million by 2012, with 0 time investment and 0 tenant phone calls about broken water heaters. The difference between $1 million and $2.4 million is $1.4 million, plus 20 years of his life he spent being a landlord instead of doing literally anything else. That's the opportunity cost nobody calculates when they're buying rental property. Now let me address something even more culturally sacred than real estate, because this one's going to really challenge some deeply held beliefs. Gold, silver, precious metals. Commodities that produce nothing, generate no cash flow, create no value, and sit in a vault somewhere while you hope someone else will pay you more for them tomorrow than you paid today. This might be the most irrational investment humans ever created. And I spent 7 decades watching intelligent people pour wealth into it for reasons that collapse under the slightest logical scrutiny. Here's the argument for gold. And I heard this constantly throughout the 70s when inflation was raging. It's been valuable for 5,000 years. It's a hedge against inflation. It's a crisis hedge when paper money becomes worthless. It's tangible and finite. Governments can't print more of it. All of that is technically true. It's also completely irrelevant to building wealth. Let me walk you through the actual mathematics of gold ownership from 1975 to 2000, a period I watched very closely. Gold appreciated from about $165 per ounce to about $275 per ounce over those 25 years. That's roughly a 65% gain, which sounds okay until you compare it to literally any productive asset. The stock market over that same period went up roughly 15 times. A dollar invested in stocks in 1975 became $15. A dollar invested in gold became about $1.65. But it's actually worse than that, because gold has carrying costs. If you buy physical gold, you need to store it somewhere secure. If you store it at home, you risk theft. If you store it in a safe, deposit box, or vault service, you pay annual fees. If you buy gold through a fund, you pay management fees. Meanwhile, stocks paid dividends that compounded over those 25 years, turning that 15 times return into something closer to 25 times if dividends were reinvested. Here's the fundamental problem with gold that nobody wants to acknowledge. And this is something I tried to explain to colleagues over and over again. It's not an investment, it's speculation. Investment means putting capital into something that produces a return, a business that generates profit, a bond that pays interest, real estate that generates rent. Gold just sits there. You buy it, store it, hope someone pays. You more for it later. That's not investing. That's the greater fool theory. You're betting that a greater fool will pay more than you did for something that produces nothing. Have you ever noticed that gold investors are always waiting for the collapse, the hyperinflation, the currency crisis that will finally prove them right? I watched this psychology play out for decades. Meanwhile, the world kept functioning, businesses kept producing, and the stock market kept compounding. I never bought gold, not an ounce. Not as a hedge, not as insurance, not as a speculation. Every dollar I could have put into gold went into businesses instead. Over 7 decades, that decision compounded into a wealth difference so vast that I can't even calculate it precisely. The fee trap, the digital delusion, and the false security, the fourth wealth destroyer I avoided, combine the worst features of whole life insurance and real estate, high fees, illiquidity, poor returns, and complexity that disguised how bad the deal actually was. I'm talking about actively managed mutual funds, hedge funds, private equity funds, any investment vehicle where you pay someone else, usually 1 to 2% annually plus performance fees, to invest your money for you. This might be the most lucrative scam in financial history, and it worked for decades because it appealed to a fundamental human weakness, the belief that experts can do what we can't and that superior returns are worth paying for. Let me destroy that belief with mathematics, because this is something I studied extensively in the 1970s and 1980s when these products really exploded. The average actively managed mutual fund charges about 1.3% in annual fees. That doesn't sound like much. It's barely noticeable on your quarterly statement. But over 30 years, that 1.3% fee costs you approximately 35% of your total returns. Not 35% of your fees, 35% of your wealth. If the market returns 10% annually, and you're paying 1.3% in fees, you're not getting 8.7%. Because of compounding, you're getting about 6.5%. And that's assuming your fund manager matches the market return before fees, which 95% of them don't over long time periods. The actual data is devastating for the active management industry. And I compiled much of this research myself over the years. Over 15-year periods, approximately 92% of active fund managers underperform their benchmark index after fees. Over 20-year periods, it's 95%. Over 30 years, it approaches 98%, which means if you pick an actively managed fund, you have a 2% chance of beating a simple index fund that charges 0.03% in fees and requires zero expertise to buy. Those aren't odds. That's a certainty of underperformance. I met a hedge fund manager in the late 90s who generated 30% annual returns for 5 years. Brilliant guy. Wharton MBA, worked at Goldman Sachs, had a proprietary trading system he developed. He was managing about $50 million. I asked him what he thought would happen to his returns if he had $5 billion to manage instead of 50 million. He got very quiet. Then he admitted that his strategy wouldn't scale. His edge existed in small, inefficient pockets of the market that couldn't absorb large capital flows. That's when I understood the hedge fund business wasn't about making investors rich. It was about making hedge fund managers rich. I never invested $1 in a hedge fund. I never bought an actively managed mutual fund once index funds became available in the 1970s. Every dollar I could have given to an expert manager went into low-cost index funds or individual stocks I researched myself. Now, the fifth wealth destroyer didn't exist for most of my career, but I want to address it because the principles I use to evaluate investments would have led me to the same conclusion if I'd lived to see it fully develop. Cryptocurrencies, Bitcoin, Ethereum, whatever new coin is being promoted as the future of money. Based on everything I understood about monetary economics, let me be very clear. It's not currency, because hardly anyone uses it to buy things. It's not a store of value because it fluctuates wildly. It's not a productive asset because it generates no cash flow. It's not a commodity because it has no industrial use. It's a digital token whose only value is what someone else will pay for it, making it the purest form of greater fool speculation ever created. The arguments for cryptocurrency fall apart under minimal scrutiny, and they're arguments I've heard in different forms throughout my entire career, just applied to different assets. First, the scarcity argument. Bitcoin is limited to 21 million coins, which makes it inherently valuable. But scarcity doesn't create value. Usefulness creates value. I could create a limited digital asset right now. There will only ever be 21 million Milton coins in existence. Does that make them valuable? Of course not. Second, the decentralization argument. Cryptocurrency is free from government control, which makes it superior to fiat currency. But the alternative they're proposing, a deflationary currency that increases in value over time, creates its own massive problems. If your currency becomes more valuable by holding it, nobody spends it. Economic activity grinds to a halt. We know this from history. The gold standard created deflationary spirals that led to depressions. That's why every developed economy moved to fiat currency. Have you ever asked yourself why the most sophisticated investors, the Warren Buffetts, the institutional endowments, the pension funds managing trillions, avoid cryptocurrency almost entirely? It's not because they don't understand the technology. It's because they understand the difference between revolutionary technology and sound investment. The sixth wealth destroyer was something paradoxically popular among people who considered themselves sophisticated investors: individual bonds, corporate bonds, municipal bonds, treasury bonds, any fixed income security where you loan money to an entity in exchange for a promised interest rate. On the surface, bonds seem like the safest, most rational investment possible. You know exactly what you'll get paid and exactly when. No volatility, no uncertainty, just steady, predictable returns. The problem is that steady, predictable returns are steady, predictable wealth destruction once you factor in inflation and taxes. Let me show you the mathematics from the 1990s, a period when people really piled into bonds. A 10-year Treasury bond yielded approximately 6%. Seems reasonable, but inflation was running about 3% annually. So your real return after inflation was 3%. Then taxes. If you were in the 39.6% tax bracket, which many high earners were, you paid 2.38% of that 6% to the government, leaving you with 3.62%. Subtract 3% inflation, and your real after-tax return was 0.62%. You're barely keeping pace with inflation after working your whole life. I watched friends build bond portfolios in the 1980s and 90s because they're financial. Advisors told them that at their age they needed safety and predictability. Those friends retired with portfolios that generated $50,000 or $60,000 in annual income from bonds. Sounds comfortable until you realize that $50,000 in 2005 bought what 20 to 5,000 bought in 1985. Meanwhile, I kept 100% of my investable assets in stocks, productive businesses that raise prices with inflation, grow earnings, increase dividends. My income in retirement grew at 8 to 10% annually. The only financial safety comes from owning productive assets that grow in value faster than inflation. Bonds don't do that. Bonds are a bet that the future will be worse than the past, that economic growth will slow, that businesses will stop innovating. It's a profoundly pessimistic investment thesis, and pessimism is expensive. The seventh and final investment I avoided was perhaps the most emotionally difficult to resist because it wasn't marketed as an investment at all. It was marketed as a lifestyle choice, a symbol of success, a reward you deserved: new cars. This might seem strange to include in a list of investments, but that's exactly the point. People treat cars like investments. They finance them, trade them in, upgrade them regularly, when they're actually one of the worst financial decisions you can make. In the 1970s, the average new car cost about $5,000. Most people financed it over 3 or 4 years, at 8 to 10% interest. By the time you paid off the loan, you'd paid $6,000 or more. But that's not the real cost. The real cost is opportunity cost. What that money would have become if you'd invested it instead. $5,000 invested at 10% annual returns becomes $13,000 in 10 years, $35,000 in 20 years, $91,000 in 30 years. That's not a rounding error. That's retirement security. And people spent it on a car that was worth maybe $500 after 10 years. If I were advising someone starting today, and this is exactly what I would do if I could start over knowing what I know now, here's the complete strategy. Buy term life insurance if you have dependents. Zero permanent insurance ever. Rent a modest home or buy a small home you can pay off quickly, and invest every dollar you don't spend on real estate and index funds. Buy zero gold, zero cryptocurrency, zero individual bonds except for short-term liquidity needs. Invest in the lowest cost index funds available, probably a total market index fund, and never sell. Buy a reliable used car and drive it until it dies, then buy another reliable used car. Avoid every financial advisor who charges a percentage of assets under management. Read annual reports and learn how businesses work. Save at least 30 to 50% of your after-tax income. Do this for 30 years without deviation. The result would be financial independence by your 50s and wealth by your 60s, regardless of starting income, regardless of luck, regardless of market timing. Because the mathematics of compound interest are undefeated. 8% annual returns double your money every 9 years. In 30 years, that's 3 doublings. $1 becomes $8. 100,000 becomes 800,000. 500,000 becomes 4 million. The only question is whether you can avoid the 7 wealth destroyers long enough to let compounding work. Most people can't. They get sold whole life insurance in their 30s. They buy investment real estate in their 40s. They panic into gold during a crisis. They pay mutual fund fees for decades. They speculate on cryptocurrency. They hide in bonds for safety. They buy new cars every 5 years. And they retire at 65 with less than they would have had if they'd simply bought an index fund at 25 and never touched it. That's the tragedy. The solution is simple, free, available to everyone, and requires no special knowledge or expertise. But it requires the one thing most people can't sustain, the willingness to ignore conventional wisdom, resist social pressure, delay gratification, think in decades, and be boringly consistent. I spent 70 years being boringly consistent. I avoided the 7 wealth destroyers. I bought productive assets and held them. And the difference between my approach and conventional wisdom wasn't millions of dollars. It was tens of millions of dollars. Not because I was smarter, because I understood that what you avoid matters as much as what you choose. So here's what I want you to do right now, today, before you close this page. Look at your current investments. How many of the 7 wealth destroyers are you currently paying for? Whole life insurance, investment real estate that's underperforming stocks, gold sitting in a vault, actively managed funds charging 1% or more, bonds yielding less than, inflation plus taxes, a car payment on a depreciating asset. Calculate what those decisions are costing you, not just in fees, in opportunity cost, in wealth you could build over the next 20, 30, 40 years if you redirected that capital into low-cost index funds. The mathematics will shock you. And that shock might be exactly what you need to make a different choice. Because the difference between retiring comfortable and retiring wealthy isn't your income. It's not your intelligence. It's not even your discipline in saving. It's whether you can avoid the 7 wealth destroyers long enough to let compound interest do what it does best. Turn time into money and consistency into generational wealth. That's my legacy. That's what 7 decades of observation taught me. And that's what I'm passing on to you today. Take it seriously. Your future self will thank you.